that FHFA is facilitating to the Servicing Alignment Initiative, reducing the GSE's footprint in multifamily housing, to the enterprises launching risk-sharing transactions that will try to gauge the private market's appetite for mortgage credit risk. While the director is quietly but aggressively pursuing these reforms, we're also seeing a number of other policy changes take shape that will leave a lasting imprint on our mortgage markets. As home prices stabilize and the economy recovers, the Federal Reserve has indicated it is willing to reduce its support for mortgages, which helped send interest rates up significantly in just the last month. The administration has taken aggressive steps to shore up the insurance fund of the Federal Housing Administration, that is FHA, though I think we all acknowledge that legislative reform is also needed. The Consumer Financial Protection Bureau is completing their mortgage rules under Dodd-Frank, trying to balance concerns about access to credit with a desire to prevent the types of predatory lending that led to the 2008 crisis. And our banking regulators may finalize Basel III next month and are trying to sort out how various categories of mortgage loans will be treated for capital purposes. Just this week, we saw substantial movement forward on housing finance reform, with Senators Corker and Warner introducing a bipartisan reform proposal to wind down Fannie Mae and Freddie Mac and replace them with a government reinsurance company that provides a catastrophic guarantee on mortgage-backed securities. I hope to discuss this proposal and others more thoroughly during today's panel. And of course, we saw my colleague and dear friend, Congressman Mel Watt, perform spectacularly at his nomination hearing to be the new head of FHFA before the Senate Banking Committee. I hope that the Senate moves forward quickly to confirm Congressman Watt to that position. So with that said, I am very much interested to hear from the industry participants we have here today about their perspectives on reform. At our last panel discussion, we learned about proposals to create new chartered mortgage institutions that would sell credit insurance on qualified mortgage-backed securities. We heard about a plan to allow the GSEs to recapitalize through retained earnings, and we heard about a plan that would have a new public guarantor sell a limited government guarantee for the single multifamily markets. This last structure is very similar to the Corker-Warner proposal unveiled this week. And I'm curious to hear the panel's thoughts on now that it has been fleshed out in legislative text. I hope that we can have a robust discussion and one that gives more perspective on the various approaches that have been floated by both members of Congress and outside stakeholders. Creating a stable and liquid housing finance system that provides certainty to market participants is crucial to the health of the American economy and should be a top priority of the Financial Services Committee. I'm now going to introduce the panelists, but I think one of our members did just come in. Please welcome Mr. Carney of Delaware.
Morning.
Thank you. Good morning. You sound real robust this morning.
Just got out of the gym.
Oh, good. You're ready to go. Okay, I'm very pleased to introduce our panelists for today's event. Our panelists today represent various different aspects of the mortgage market, both single-family and multifamily housing, from realtors to lenders to originators to securitizers and investors. First, we have with us Mr. Tony Hutchison, Senior Policy Representative, National Association of Realtors. There he is. Okay. Next, we have Ms. Cindy Shetty, Senior Vice President of Government Affairs, National Multi-Housing Council, and former staffer for the Financial Services Committee. Thank you, Ms. Shetty. Third, we have Ms. Ann Grochala, Vice President, Lending and Housing Policy, Independent Community Bankers of California, of America. Fourth, I'm thinking about home. It's time to go home today. Fourth, we have Mr. Bill Hampel, Senior Vice President and Chief Economist, Credit Union National Association. Fifth, we have Mr. Mike Frantantoni, Vice President of Research and Policy Development, Mortgage Bankers Association. And last but not least, we have Mr. Tom Dorsch, who is Executive Director of the American Securitization Forum. Would you join me in welcoming our panelists? Thank you. To start the discussion, can each panelist give some brief remarks about the need for reform and their view as to how to best proceed? We want to have ample time for discussion, so I would ask you in this brief opening period that you have to make your remarks brief to about 3 minutes each. So let us get started right with the first person that I introduced, Mr. Tony Hutchison.
Thank you, Congressman Waters. Thank you all for having me here today to speak on behalf of the National Association of Realtors. We do believe that right now is the time to move forward with reform of the GSEs and housing finance in general. We've been in conservatorship for a significant period of time, and we recognize that that is not a suitable or stable for the marketplace. We would like to see legislation put forward that can start a substantial discussion so we can begin to move forward trying to figure out where we're going to go from here. Realtors recognize that it will take time to implement any change. There's going to be time needed to spin up whatever new model is put in place or to shake out any of the old issues that the old model has so that we can go forward. For the National Association of Realtors, now 1 million members, the thing of importance to us is that, one, we ensure that there is a sustainable flow of mortgage capital in all markets under all economic conditions at all times. That does not mean that we're looking for whatever entity is put in place to prop up the entire market. We do believe that private capital needs to be there. But whatever is going to be put in place needs to be somewhat of a shock absorber. So when private capital goes away, there is no receding of total mortgage capital so that the system comes to a complete halt. The other thing that is a major tenet for us is we want to ensure that there is long-term fixed rate financing in the marketplace. And we believe in order to have that happen, there needs to be some form of government guarantee. How that occurs, we're open to debate on that, but we believe that in order for consumers to have affordable long-term financing at a rate that we have seen similar in normal times in the past, that there needs to be some level of government involvement. I'll leave those in my remarks. I know we have a number of other folks here, and then I'll be happy to discuss those and any of the other proposals that were put forward. Thank you, Ms. Waters and Congressman, for having me.
Thank you very much. Before going to our next panelist, we have two members of the Financial Services Committee that's joined us. Mr. Mel Watt, the gentleman that I mentioned just a moment ago, is here. Raise your hand there. And Ms. Velasquez from New York. Would you raise your hand, please, so they'll see that you're here. Thank you very much. Now, next we'll hear from Ms. Cindy Chetty.
contributed $10 billion since the entities were put into conservatorship. So what we are most concerned about and what we are talking to to the members about is that when you go forth about doing a reform effort, you need to make certain that the multifamily industry is dealt with in a manner that understands the unique nature of that business. It is very different. If you remember when DeMarco testified before the Housing Finance Committee, Financial System Committee, he talked about the fact that many of the things that he's setting up on a single family or that he's looking at in terms of platforms and whatever, we're already doing that on the multifamily side. There already is a risk profile there. So one of the things that we like about what Mr. Corker did and Warner did in their bill is that there is a separate section in the Corker-Warner bill that I think recognizes the uniqueness of the multifamily industry. And what they've done in that bill is regardless of the structure, I like what they've done, they've taken the multifamily portion of the business and basically left it intact with all the platforms intact. So we would hope moving forward that we can work with the members of Congress to determine a solution for multifamily that will work. But it is not going to be the same solution that you are going to perhaps determine on the single family side.
Thank you very much. And let me ask each of the panelists to turn your microphone on for live streaming. You're being seen and you're being heard. Okay. Next we'll have Ms. Ochala.
Start again. Good morning. I am Ann Grishala, Vice President of Lending and Housing Policy at the Independent Community Bankers of America, which represents over 7,000 community banks across America. Community banks and the communities they serve have a large stake in the future of housing finance, and we are keenly interested in proposals to reform the secondary market. Thank you for the opportunity to participate in this important discussion. Community banks represent about 20% of the mortgage market, but more importantly, their lending is concentrated in small towns and rural areas across our country, which are not often effectively served by larger banks. Any mortgage reforms that constrain lending by community banks will seriously harm these communities. Access to a robust market is vitally important to community banks, as they do not have the resources needed to effectively hedge the interest rate risk inherent to long-term fixed-rate lending. Secondary market sales make it possible for community banks to offer these loans without the interest rate risk exposure. ICBA has developed a comprehensive set of principles for secondary market reform, which I will summarize as follows. Community banks must have equal and direct access. They must be able to sell loans individually for cash, not securities, under the same terms and pricing available for larger lenders. There can be no appropriation of customer data for cross-selling of financial products. Community banks must be able to preserve their customer relationships after transferring the loans. Originators must have the option to retain servicing, and servicing fees must be reasonable. Servicing is a critical aspect of the relationship lending business model that is so important to community banks. There should be no retail origination. Secondary market entities must not be allowed to compete with originators at the retail level where they would enjoy an unfair advantage. Private capital must protect taxpayers. Securities issued by secondary market entities must be backed by private capital and third-party guarantors. Government catastrophic loss protection, which is critical during times of market stress, must be fully and explicitly priced into the guarantee fee and loan level price. Any reforms that are not consistent with these principles could drive further consolidation of the mortgage market, which would harm borrowers and communities and put our financial system at risk of another collapse. Again, thank you for the opportunity to share our views. We look forward to working with you as the Financial Services Committee takes up housing reform, and we hope you will recognize the critical role played by community bank mortgage lenders.
Thank you, Ranking Member Waters, for holding this important panel discussion and for inviting the Credit Union National Association to participate. CUNA is the largest advocacy organization representing the nation's almost 7,000 credit unions and their 97 million members. Credit unions have been actively engaged in mortgage lending since the 1970s, and our volumes have grown, especially since the beginning of the financial crisis. Last year, credit unions originated $120 billion of first mortgage loans, representing about 6.5% of the market. We are now significant players in the residential real estate finance. Credit unions originate mortgage loans both for their own portfolios and for sale to the secondary market. The decision to hold or sell a loan depends primarily on the management of interest rate risk and varies through time. Before the financial crisis, credit unions sold only about 1/3 of their new loans. Since then, as long-term interest rates have plummeted, credit unions have found it prudent to sell over half of their loans. In the first quarter of this year, we sold about 60% of our new loans. The fact that many loans will be held on credit unions' books makes them prudent lenders. The fact that interest rate risk management often requires selling a significant portion of loans means a robust, effective, and accessible secondary market is vital to credit unions. We fully appreciate the need to reform the current system of housing finance, but we're concerned, however, that reform does not hinder the ability of credit unions to meet their members' housing finance needs in a member-friendly way. We too have a few principles that we hope the new system will accommodate, and I'll go through these very quickly. First, as for the ICBA, there must be equal and open access to the secondary market for lenders of all sizes. We understand that the cost of accessing the secondary market may rise in the future, but that cost and fees should not have any relationship to lender volume. Second, the entities providing secondary market services must be subject to rigorous regulatory and supervisory oversight to ensure safety and soundness and equal access. They should have strong capital requirements, but also flexibility to innovate. Third, the new system must ensure that even in troubled times, mortgage loans will continue to be made to qualified borrowers. Fourth, the new housing system should emphasize consumer education and counseling as a means to ensure that borrowers receive appropriate mortgage loans. Fifth, the new system should include consumer access to products that provide predictable, affordable mortgage payments to qualified buyers. Traditionally, this has been provided through the 30-year fixed-rate mortgage. Six, the new housing finance system should apply reasonable conforming loan size limits and adequately take into consideration variations in local real estate markets. Seventh, the important role of government support for affordable housing should be a function separate from the responsibilities of the secondary market entities. The requirements for a program to stimulate the supply of credit to lower income borrowers are not the same as those for the more general mortgage market. We believe a connection between these two goals could be accomplished by adding a small supplement to guarantee fees, the proceeds of which could be used by some other federal agency in a more targeted fashion to further affordable housing goals. 8, most market participants define servicing as the process whereby monthly payments from borrowers are routed to investors and how delinquencies are dealt with. While credit unions understand the importance of those functions, they also view loan servicing as an opportunity to continue providing excellent service to their members after the loan has been made. Credit unions are concerned about the confidentiality of their members' data in the loan securitization and servicing process and should be able to continue to perform servicing for their members in the future. And finally, number 9, the transition from the current system to any new housing finance system must be reasonable and orderly. Ranking Member Waters, thank you for the opportunity to present our views, and we'd be happy to respond to your questions.
Thank you very much. We have been joined by Congressman Bill Foster of Illinois, Congressman Dan Kildee of Michigan, and Congressman Capuano of Massachusetts. Thank you. Carol Maloney from New York. Thank you. All right, next we will go to Mr. Mike Ferratoni.
Hi, good morning, Congresswoman. My name is Mike Frattantoni. Thank you for the opportunity to speak here today. I'm speaking on behalf of the Mortgage Bankers Association. We represent more than 2,000 companies, small members, large members, banks, non-banks, credit unions, life insurance companies in the single-family, multifamily, and commercial mortgage markets. So we provide a broad perspective on this issue. MBA believes that the future secondary market should address the needs of borrowers, lenders, investors, and taxpayers. Private capital should be the first line of defense against losses, with no institution too large to fail. The ideal system should promote liquidity and stability by connecting global pools of capital to the U.S. mortgage market, should provide certainty of execution for middle-class borrowers, should provide competitive pricing for a consistent offering of core products, including the 30-year fixed-rate prepayable mortgage. It needs to be able to provide an efficient means of hedging interest rate risk, i.e. we need to have a TBA market. And most importantly, it needs to support a vibrant, dynamic, and competitive both primary and secondary markets composed of lenders with a wide range of sizes and business models, with this competition ultimately benefiting homeowners. The government's role is to provide quality regulation of guarantors and systems and to provide a clearly defined catastrophic credit backstop. We think this is really an important component of this ideal system that we're envisioning. Without this government backstop, the mortgage market would be smaller and mortgage credit would be more expensive, meaning that middle-class households would have less access and be less able to qualify to achieve sustainable homeownership. It's important to recognize that the mortgage market would be composed of three different segments, though. There will always be a fully private market that's not limited by loan size or by particular loan characteristics. This fully private market would still be held to all applicable regulations, but those loans might be put on balance sheets or securitized through non-agency channels. The second segment is what we're talking about here, which would be a conventional conforming market with a government backstop. Middle-class households need access to a market that has private capital taking the first loss, but an ultimate government backstop to ensure ongoing market liquidity. And our view is that only traditional, well-documented loans that qualify as QM should enter this core market. The third segment, the government segment, is critically important as well. FHA, VA, Rural Housing Service should continue in their present roles performing critical social policy functions. These programs are directly backed by the government and are targeted to support lending to first-time home buyers and others who could only access homeownership through a low down payment product. Let me turn now to the current market situation and steps we can take to move towards a market more in line with our goals. Fannie Mae and Freddie Mac have recently reported substantial profits, leading some to ask whether the business models of Fannie Mae and Freddie Mac have regained credibility that was lost during the financial crisis. Record GSE profits do not tell the whole story, though. In their current form, GSE profits are dependent in large part on three factors: guarantee fees, which have more than doubled in recent years, a remarkably low-risk business, which is a sign of very tight credit in the mortgage markets, and their ability to shift legacy costs back to lenders in the form of repurchase demands. This current status is not sustainable over the longer term, and MBA believes that we should begin moving towards a more sustainable environment. There are both short and long-term steps that can be taken to begin the orderly transition to Congress's preferred secondary mortgage market framework. For the long term, we really need Congress to develop a comprehensive vision for an end state. With that end state, we also need an orderly transition plan that implements the desired end state without causing material disruptions to the market. There are a number of bills that have been introduced over the past couple of years that are broadly in line with the direction that MBA supports. In the short term, though, while the legislative process is underway, MBA has proposed a set of transition steps designed to move in the direction of the developing consensus regarding the shape of the future secondary market. Each of these will provide better value to borrowers. So let me just go through the 5 steps we proposed really quickly. First, we think we should move towards a common fungible mortgage-backed security to improve liquidity in the market. Second, we think we should make increasing use of risk sharing at the front end of the mortgage transaction to lower costs and increase access to credit. Third, we need to make sure that smaller lenders have securitization options that to level the playing field, allowing them to go directly to the secondary market. Fourth, we need a well-regulated credit framework with clear rep and warrant protections to increase transparency. And then finally, we do agree that the market does need a functioning and transparent common securitization platform to lay the groundwork for a more efficient market in the future. So I'd be happy to take any questions, but thank you again for the opportunity to speak here today.
Thank you very much. Now we'll hear from Mr. Tom Deutsch.
Thank you very much, Ranking Member Waters, and for all those attending this morning. I'll focus my comments more conceptually on I'll call it four key things that as we go through the Q&A period, I'll come back to probably each one of those four and any of the questions that I respond to. By way of background, the American Securitization Forum represents, we'll call it the entirety of the shipping business of securitization. The originators who originate the loans, the issuers and broker-dealers who package and sell the loans, and ultimately, and where I'll focus most of my comments today because I think I'm the only representative from the institutional investor community, is the investors who buy mortgage-backed securities, both government guaranteed as well as private label issuance. The four key comments that I'll have and themes that I'll go through in my comments today are one is that investors do have capital that they want to put to work. And they'll do that under three conditions, though. One is the price. If any investor will buy anything, depending on the price. But it goes along with two other key items, which is both term and certainty of the terms. So the terms are contractual provisions, reps and warranties, and the like. But the other aspect of it is the certainty of the terms. If an institutional investor puts their pension money, pension funds, mutual funds to work, they have to make sure that they're getting appropriate returns to that, as any fiduciary should. A key part of that, though, is that rules have changed or can change. Just as an example, and this is a real lightning rod in the investor community right now, is proposals around eminent domain to effectively seize mortgages. North Las Vegas right now is in the middle of considering this. Richmond, California has been in the middle of considering this. If you change those rules of the game, you effectively change what people believe are constitutional rights, that you can't take my property without just compensation, investors will not want to come back to those markets if they don't view those certainty of terms there. So that, I think, will be a critical component in all of the discussions, is to make sure that those terms are certain and that we don't have these sort of let's redo the rules when we don't like the rules later on. Secondly, I'd focus on a supply versus demand debate. There's a lot of people out there who would say, well, investors are on strike right now because the shipping business of securitization is broke. And I will agree, right now, if you think of securitization as a shipping business, the name of that business would be two guys in a truck. Right now, there's approximately, this year, maybe expected to be about $15 billion of mortgage-backed securities issued without any government guarantee. $15 billion sounds like a lot to me, but in the grand scheme of things, it's not even a drop in the bucket of the mortgage market, because currently, the expected issuance volume of mortgages this year will be over $1 trillion. So $15 billion of mortgage-backed securities does not make securitization, at least right now, a viable shipping model for the entirety of the mortgage market. So some will comment on that and say, well, the system is broken. My response to that is no, there's not enough supply of mortgages into the system. Given the size of the footprint of the GSEs originating, whether it's through FHA as a guarantor or the GSEs, they're still guaranteeing over 90% of the loans. You say, well, why doesn't the private market take some of that market share? Two key issues come out of that. One, there is a competitive imbalance between the GSE's ability to execute for conforming loans, and two, the high level of conforming loan limits. When mortgages in the country can be made up to $625,000 and be sold to the government, it leaves very few mortgages out there that private label securitizers can actually put into packages and sell to investors. So our proposals don't necessarily focus on bringing 625 down to zero, but it does mean ratcheting down, and I think that's one of the key things of the Corker-Warner bill that is very appropriate, is that over time, having a $40,000, $50,000 a year ratcheting of the loan limits, no one, I think, would support dropping it immediately from, say, 625 to 300 overnight. That would cause significant difficulties in the market. My third key point is around timing of change related to any big picture change within GSEs. No institutional investor wants to see we'll analogize this to landing an airplane. Nobody wants to see some maverick landing on an aircraft carrier doing this very quickly or inappropriately or without deliberation. This is landing a very large transport plane. You got tanks and guns and the whole works in the back here when you're trying to land this thing. So it has to be done carefully and with a long landing strip. Having said that, I do agree with Mike that we do need effectively two teams working on GSE reform. You need a team that's thinking about this long-term and creating the infrastructure long-term, but you also need a team, and I think Acting Director DeMarco is doing a fair job of this, is creating near-term changes that are appropriate. As an example, Fannie and Freddie were created to be competitive entities over time. Back in the 70s, when Freddie really started growing up, they effectively were viewed as, well, we'll have two different players in the market that will sort of compete and keep each other honest. The problem is now they're not competitors. They're both effectively wholly owned. There may be some hedge fund investors who own some common shares or preferred shares within Fannie and Freddie. But my view is that the U.S. government owns both of them at this point. And if they own both of them, there's no need for them to compete. So let's start bringing their standards together. Underwriting standards, servicing standards, desktop underwriting systems. And that, I think, is where investors and issuers largely do agree, although I think investors are a bit cautious about one common security, making sure the entities start really looking alike and the securities really do perform alike before you start creating one fungible security. I guess my fourth and final point, and I know I'll get asked this over and over again, I call it the field of dreams concept, is if we build it, will investors come? It's sort of the million-dollar question of GSE reform. If there is all of this private capital foundation built, will investors bring money to the table? And I think the key answer is yes, absolutely. Over time, they will and can take up government market share. I do not, nor would any institutional investor support tomorrow, overnight, going from 90% government guarantee market to 0% or 20% or 25%. This is a ratcheting process. We're at 90%. My goal, and I'd be dancing a jig if 3 years from now or 5 years from now we have a 50% market share for the government and 50% private capital or private guarantee. That is what, in effect, maybe that makes me sort of, I don't know, Ray Liotta coming out of the cornfield here, is saying that they will, if you do build it, they will come, they will bring capital to the system, but it does take time.
Thank you very much. Ladies and gentlemen, we've been joined by Congressman Mel Watt, and I mentioned him before he came in the room. He was in a confirmation hearing over on the Senate yesterday, and I'd just like to have some comments from him. Before you do that, let me just say to you that I think that we are very fortunate to have had you nominated, having served for so long on the Financial Services Committee. You're so familiar with all of the work of that committee and certainly with the GSE. So I'd just like to hear your thoughts, if you would share them with us this morning.
Good morning, everybody, and thank so much to Maxine for Congresswoman Waters, I'm sorry, for Max, as I call her, for convening this group. I slipped Max a note and said I have to leave. I actually have to leave for two reasons. One, because I'm trying to get out of town, but second, because I'm trying to keep from engaging in discussions about these issues. And I distinguish between discussions about these issues and listening sessions about the issues. One of the wonderful things about the series of hearings of this kind and discussions of this kind that Congresswoman Waters has been convening is the ability to listen to people and understand all of the perspectives that they bring to this issue, and to acknowledge that this system going forward is not going to work without input and participation from everybody sitting at this table and your constituencies and everybody who's been at the some of the prior discussions that have been convened in this room and other places. So that's just this is a great forum leading up to whatever the House is going to do about creating a bill in this space. The second thing I wanted to do quickly, and I may be inappropriately using the forum for this, is to express thanks to those of you in the room who have provided support to my nomination and been in vocal support of it. And I want to particularly single out the realtors whose letter was entered into the to the confirmation hearing record yesterday in the Senate Banking Committee. I also want to acknowledge that I understand that there are other folks whose jury may be still out, while I can't be out actively meeting and trying, that's not why I'm here. I hope that you'll continue to listen and be an active participant in this. And while you do not vote on the Senate Banking Committee or in the Senate, I recognize that every one of you plays an important role in your industries play an important role. And the one assurance I want to be able to give everybody is, and that's what I liked so much about the letter that came from the realtors, when they said, look, we haven't always agreed with this guy, but what we found is that he's been open and transparent and honest, and that his door has always been open for a full-blown discussion of all sides of an issue. And that's going to be necessary going forward, both in the creation and standing up of this single securitization platform, and as we go forward to resolve a number of these other issues, we are going to have the input of the people, the players in this industry, if we are going to get the right answer. And that's not only the right legislative answer, what the future shape of housing finance will be in this country, but throughout the transition to that, how we build the bridge between where we are now and where we are going to. So it's important for you all to be active participants. I'm not here to ask for any of your endorsements. That's you all have your own interest, and I expect you to have those own interests. I'm glad that Tom acknowledged the great work that Ed DeMarco has done in starting this transition and starting to build the platform. And I want to publicly acknowledge I didn't get a chance to do it yesterday because I never got asked the right question. But I want to publicly acknowledge the cooperation that he has provided to me during this confirmation process. So this is not about either me or Ed DeMarco. This is about, from an agency perspective, getting us from where we are today to where, from a legislative perspective, Congress says we are going in the future. So thank you all for being here. Thanks for allowing me to slip in and slip out. But the presentations, I'm great on the listening aspect. I just don't want to be involved in the discussion aspect at this point. So I hope you all can understand that dichotomy I'm making. I've got kind of an awkward situation right at this point. So thanks very much for your participation, and thanks to you for convening.
Mr. Capuano, you're standing over by the door. Mr. Capuano, come back in here. I order you to sit down, Mr. Capuano. And you'll be back? Okay, all right. Thank you. Ladies and gentlemen, before we go right into our questions, I know that many of our members have been focusing on this issue, anticipating us coming up with some kind of legislation or weighing in at some point in time. So before I lead you in some of the questions that we have organized, I'd like to ask the members if you'd like to have something to say and maybe incorporate your question. We'll go through all of the members and then we'll turn it over to the panel. What's on your mind? Do you have a question? The question won't be answered directly at this point, but it will be incorporated into the question and answer period. So if any of the members would like to do that at this point, we'll start with you, Mr. Kildee. I thought you had your hand.
Thank you very much.
Yes.
And I assume that we'll get into the broader question of what a successful structure might look like. So I'll take this opportunity to zero in on one particular point that is it Deutsch? Is that you made, because it might not otherwise be picked up. And it has to do with the reference to when communities are beginning to respond to the issues that are becoming so difficult for them to deal with. I'm new to Congress, but I was in local government for 25 years and worked on land banking issues. And you raised the issue of the use of eminent domain. It's an issue that I'm very interested in. There are a lot of serious questions about how that might work. But one point that you made relates to the constitutional protection against the taking without just compensation. And I want you to, or any others, to comment on whether that's your perception of what's being contemplated, because in all the work that I've ever done at the local government level, any taking did result in an adjudication by a third party determining the compensation due to the title holder. Number one. But secondly, I'm wondering if you might be more open as an industry to a different discussion that would lead to negotiated transactions, not taking, in a structure that we might be able to support that would allow communities to get at what they're trying to get at, help determine their own destiny, but do so in a way that results in a negotiation and does not initiate with the
Excuse me.
all the trappings of a taking, but something that would allow communities to
There are seats up here.
to acquire not just title but also pay.
Come on, Miss Beatty. Come on.
Might help them
It's the
to
seat over
problem
here.
that the main issue is trying to get at.
Got it. I'll take it as there's really two questions. One around.
Excuse me, we're not going to go directly to the answers yet. I want to get the questions and the feelings from all the members, and then we'll go into our general discussion and answers. Anybody else with Mr. Carney?
Yeah, we had a guy by the name of Jim Milstein in here over the last month or so ago. We've got a fairly detailed proposal about the end states, the end state. And I'd be interested in your thoughts on that model. And then secondly, somebody else mentioned maybe you might, the transition and how important that was. Jim acknowledged the really critical importance of the transition from where we are today to whatever the end state is. And
Right.
I'd like to know if anybody's kind of marked that out or what you think is an appropriate process for marking out a transition from where we are today to the end state.
Mr. Foster, did you have?
We will discuss the issue of the interest rate risk and the credit risk and the merits from your point of view of retaining a lot of the credit risk, a lot of the privacy information also with your members and your customers. And so there are models, for example, I believe the federal home loan banks that provide products that allow you to offload the interest rate risk while retaining the credit risk. And so I was wondering if you have a reaction, have they performed well in the crisis? Are they a reasonable part of what's going forward? Because, frankly, I love you guys, but you're not always the best at managing interest rate risk. And whereas you're the best, people with permanent local connections, and the best, looking the customer in the eye and so I was wondering, both from your point of view and from everyone else concerned, are there elements of that where you'd have a separation of the interest rate risk which you put onto institutional and sophisticated investors while retaining the credit risk locally with the issuer and the servicer? I think it's a feature of the Danish system that received a lot of positive comment on the recent hearing that we had, and whether there are elements of that that really might fit into all of your views of how it needs to go forward.
Thank you. Any other members have remarks or a question you would like to ask? Yes, Ms. Velasquez.
Thank you. Coming from New York, a very important part of New York is multifamily rental properties. And I would like to hear from you any comments on keeping the multifamily structure,
Right.
secularization structure intact. And if you don't support that, what kind of multifamily products are incorporated into the financing reform, the housing financing reform?
All right, Ms. Maloney.
In support of my colleague's statement, multi-family housing financing is very important to New York. I think it's important to the country. And Mr. DeMarco, in one of his statements, felt that in the restructuring it should not be part of it, and said someone else should pick it up. But I don't see anyone else who could pick it up. And from my research, I don't think they've ever had a default on multi-family housing. It's been a successful part of the program. Secondly, I'd like to get a sense from you, since you're in the business, how much of the economy is affected by this? Mr. Deutsch mentioned the certainty is so important to investors, but we've had people testify before our committee and other meetings that the GSEs and housing finance is roughly 25% of our economy. Others have said 10%. I'd like to have a sense from you on what you feel about it. And thirdly, in response really to Mr. Kilby's statement and Mr. Deutsch's on the concern of moving for eminent domain, I think that's out of a frustration of people who, no fault of their own, they got caught in these mortgages that are below water, and foreclosing on them. Government has tried to respond in really various ways that have turned out to be disastrous. They ended up giving $3 billion to consultants that never have a solution, and money's not getting to the people. And sort of in a sense of what do you do to help this real drag on the economy and pain in people's lives on this whole foreclosure, even though it's less than what it was, it's still a huge, huge, huge problem, particularly in Nevada, California, some of the states, it's really, really huge. And should we have a specialist who helps manage this, whole department? What should we do in your ideas of how to respond to this real crisis in the families and really in some localities across the country? I want to thank you for all of your testimony today. It was really excellent.
Okay, any other questions you'd like to raise before we get started with respond? Yes, Mr. Carney.
Appreciate the opportunity. There was mention of the need for affordable some development and affordable housing. What does that look like? Does it look like what we have today or something different?
All right, thank you very much. Members of the panel, the members of the Financial Services Committee have raised any number of issues, including eminent domain issue, transition issue, interest rate versus risk versus credit risk, multifamily, and foreclosure, on and on and on. We have a Carker-Warner bill that has been introduced. Can you discuss some of these issues in relationship to that bill, or any other comments you would like to make about the questions that you have been raised? And who would like to start? Go right ahead, Ms. Chetty.
Thank you. One of the things I'd like to point out is that for our industry, we are very supportive of a very robust private market. And if you look at the various providers for the multifamily industry, they are the pension funds, the life companies, the banks, GSEs, and FHAs. And I would say that in the multifamily industry, the markets have operated exactly as we expected them or wanted them to. They have expanded when there was a crisis. And I think at one point, Fannie and Freddie and the FHA was doing 85%. Don't quote me on that. I need to go back and look at my numbers. But 85% of the multifamily that was being underwritten was being done by those institutions. But I think now we're probably at a 50%. I think maybe GSEs are at about 45% and FHA maybe 10%. So the market has reacted the way we anticipated. So going forward, at least on the multifamily side, we're anxious to make sure that, number one, there is a robust private market. And we certainly participate, and that's very important to the multifamily industry to make sure that that happens. I think that as you go forward and look at the reform efforts, the Corker-Warner bill, to your question, does recognize that unique quality on the multifamily side. And what they have done is taken the multifamily business and kind of retained it in its current structure as part of the new structure that the Warner-Corker bill creates. I think that as you all move forward, you probably need to, not probably, we would like you to do something similar to that and make sure that as you know, the focus is always single family, and so you want to make sure that when you're setting up a system for the single family that you don't inadvertently harm the multifamily industry that is operating very well. So hopefully that answers your question, but we'd like to work with you going forward. The thing that's most important for us is access to capital in all markets at all times, and that is some of what the GSEs have provided. They've provided that access, and I know there are certainly folks that make the point that you need to level the playing field, and there needs to be a better environment for the private market to participate, and we certainly support that and think that's important. That going forward, we are concerned though that you cannot create the multifamily units that you need without the government's involvement. So we believe that the government has to be involved.
We have been joined by Representative Green, Texas, Representative Cleveland, Missouri, and Representative Beatty of Ohio. Thank you very much. Any other members have anything you'd like to include in the discussion by way of your concerns or questions at this time? If not, we'll keep with the panelists. You've heard a number of the concerns. Would you like to respond?
Sure.
Yes.
Yeah, try to touch a couple of questions. First, I think MBA's point of view is that the Corker-Warner bill does have a lot of positive aspects. We're concerned about the overall cost of the structure that's being proposed, but the structure we think is a move in the right direction. If you were to compare that to what Mr. Milstein had proposed, I think there are a couple of major questions that you have to settle first. Effectively, what Mr. Milstein is proposing is just to recapitalize Fannie and Freddie as they are, sell them off to the private sector, and then with the hope that in the future additional competitors would come in to add some additional sort of competitive dynamics to the secondary market. What a lot of other plans do.
Yes, it's part of his proposal, but you wouldn't have to do it that way. You could do it a different way.
Right. And so,
wind those down and stand something else up.
but I think a lot of what his plan would do would be to take their current earnings and instead of returning those to the government, to use those to build up the capital base of Fannie and Freddie. Those earnings are then not available to build up other private sector competitors. An alternative approach is instead of standing them up again, to recognize that Fannie and Freddie have incredibly valuable infrastructure, assets, and extraordinarily talented personnel. You could redeploy all of those elsewhere. Our members are very concerned to not waste any of these valuable assets that we've built up, and that gets to your point about the transition plan. It really is, maintain the pieces, but put them maybe in a different place on the chessboard, and that'll be, I think, a viable transition plan. I want to also address the question about, Federal Home Loan Bank system. We're moving towards that now, right? They've got aligned practices in many cases. They're aligning their data requirements, aligning technology. The platform is in alignment. So I think any case where standardization helps, that's a benefit. Any case where you want competition, we're not really seeing it today because they're not really differentiating themselves anymore. Our push for common security is a place where standardization makes sense. Right now in the market, Freddie Mac's security trades a half point behind Fannie Mae's security for no reason other than it's less liquid. It's a smaller total amount of assets. That's a waste to the taxpayer. The taxpayer is effectively subsidizing the existence of that second security. That's money that could be better used elsewhere. So that's a place where standardization makes more sense. There are other places where they might be competing more effectively. I also wanted to address the issue about separating interest rate risk and credit risk, and perhaps the role of the Federal Home Loan Banks. Corker Warner, our plans, others do envision the Federal Home Loan Banks perhaps having an aggregation function for smaller institutions. That might be a valuable step to take. Another thing that we've addressed in our risk-sharing proposal is sort of go back 20 years ago to when a lot of lenders would take full recourse on the business they sent to the GSE. So they maintained that credit risk. They were securitizing just to get rid of the interest rate risk and access the liquidity in the secondary market. They'd pay a 6 or 8 basis point guarantee fee to access that liquidity and to pay for the counterparty risk that the GSEs were taking on, but they were managing their customer. They knew their customer, they were taking the credit risk. We think that's an approach that we can go back to, and this is part of our risk-sharing proposal. I think that can be built out between now and the future state, but that's something that we can do today. The industry knows how to do it. But completely agree with your point that that's a better outcome for many lenders.
Yes, go right ahead, Mr. Hampel.
Thank you. A few comments. First of all, over on Corker Warner, on our first 3 or 4 readings of it, it appears but only 3 or 4. We have several more to do. It appears to address most of our issues, and we therefore have very positive inclinations to it. One of the, for instance, particularly what we like to see is there's several references, I think 7 or 9 of them, to the fact of the requirement to provide for inclusivity to credit unions, community banks, and medium-sized banks, which we think is essential. We have a little bit of concern about the enforceability of those provisions, and therefore we just hope that the legislation could incorporate some sort of remedy for credit unions, community banks, and medium-sized banks if they feel they're not having that inclusion be able to address the issue. Congressman Foster on the issue of the home loan banks. Indeed, the home loan banks can allow protection or hedging of interest rate risk by, in essence, making a long-term loan to the financial institution. And that works in some cases, but there are 2 problems with it. One of them is that it requires making a larger balance sheet when you borrow the money, and that creates some capital issues. The other one is that most credit unions actually have plenty of excess funds to lend on their books. This sounds weird, but the household sector actually deposits more into financial institutions than they borrow from it. So we have substantial excess amounts of liquidity in credit unions that we would like to be able to lend into mortgages. And so if there were a way to hedge the interest rate risk and keep the loans on our books using the savings from from other members that we have, that would be an optimal solution. And so credit unions are looking into using derivatives in order to, interest rate swaps to manage that risk. Finally, in terms of the home loan banks, if they were to become an aggregator or a securitizer for credit unions, for smaller institutions, we think there would need to be some changes in the requirements to be a member of the home loan bank, because some of them require you hold a certain proportion of qualifying assets, and if you want to be selling those assets, you can't hold them and sell them at the same time. Just for the interest rate risk. Credit union sources of funds, basically being retail deposits, aren't that sensitive, and so the credit unions don't find the prepayment risk that much of an issue as an investor would. So the prepayment risk doesn't bother credit unions nearly as much as the interest rate risk. Congressman Maloney, the effect of housing on the economy, various subsectors of the economy, if you added up all what they say their percentage of the economy is, we'd be several 100%. But I will say that right now, as an economist, it is growth in the housing and construction industry this year that is basically saving the economy from slipping back into an almost no growth recession, which is created by fiscal stimulus taking the place. So right now, the return of housing is what is causing the economy to recover. And then Congressman Carney, on the issue of transition, our concern is that any transition is going to be uncertain. Smart people can think through what needs to be done and map out a plan, but things are going to change. Therefore, we're leery of a strict deadline for the transition to occur by. That needs to be flexible. If things work out perfectly, cool. If they don't, the transition process needs to be well thought out, but with some flexibility kept into it. And then in terms of affordable housing, again, we understand that in the new world, that in the old world we underpaid for the what was an implicit guarantee, and because it was implicit, it wasn't paid for. In a new world, we're going to have to pay for that. In addition, in exchange for if there is some form of a government guarantee, in exchange for the government guarantee, those who benefit from that government guarantee should not only prepay losses, as in many of the proposals, but should also be willing to pay a little bit extra to help and support affordable housing. And we're essentially agnostic as to how or where that's done, but we wouldn't fight a requirement to be able to fund some of that in exchange for the benefits that we get from accessing the secondary market.
Ms. Crotella, you're next, but while you are thinking about your response to our members, many folks, and I think I said in my opening statement, might be a little bit concerned about what Mr. DeMarco is doing now. Is that helpful? Does that help with the transition? He has openly talked about reducing the footprint. So include some of that in your comments, Ms. Coachella.
Okay. First of all, just some brief comments on Corker-Warner bill. We're taking a very close look at that, of course, particularly the community bank provisions and some of the Federal Home Loan Bank provisions also. And we think that there are some positive workable aspects to that bill for community banks, but we're going to continue to look at that and other proposals. Regarding the Federal Home Loan Banks, particularly the Mortgage Partnership Finance and other secondary market programs, they've been very, very beneficial to community banks, particularly as other outlets for their loans have dried up or become less friendly. And many community banks are selling their loans either through the program where the Federal Home Loan Bank manages the interest rate risk on the loan, and the lender member manages the credit risk, or the programs where they're now they're serving as an aggregator and selling loans to Fannie Mae. So, and it's my understanding that those loans that are part of the MPF program that the Federal Home Loan Banks have purchased from their members have performed extremely well, much better than the market in general. And I think that program uses the strengths of both sides of the transaction, where the members who have the very close customer relationship are in the best position to manage that credit risk, and the interest rate risk is managed by the Federal Home Loan Bank that has the sophistication and the tools and the staff to do that, something that community banks just don't have the ability to do. So those programs have been very, very helpful for our members. I know that Federal Home Loan Banks are looking at other opportunities to aggregate, and we're taking a look at those. I think there's some real possibilities there. And as we look forward to what additional things the Federal Home Loan Banks can do in terms of supporting the residential mortgage lending business of their members, we think there's additional things that they can do that can be very helpful, but we want to make sure that whatever they do in terms of the secondary market does not injure in any fashion their advanced business, which is so important to community banks and the primary business of the Federal Home Loan Banks. And that must continue to remain in a very integral part of their business. Regarding the FHFA activities, we've been looking closely and having discussions with the FHFA in terms of what they're doing, and have expressed our views when appropriate to ensure that community banks have access to the secondary market programs. Clearly, there's some things that need to be done to the infrastructure really of Fannie Mae and Freddie Mac that needs to be updated, but it's important that whatever the FHFA does going forward, that there is appropriate transparency and opportunities for the industry to comment to make sure that what they're doing is quite workable.
Okay.
Thank you.
Briefly jump in on that, because we really agree that several of the steps that Director DeMarco has taken we think are constructive, but we worry about the openness and the transparency. They seem to just be announced. There's not enough opportunity for public comment and for industry input. Some of these things may be in exactly the right direction, but we think they'd benefit by additional transparency. And then certainly the director can't provide the amount of certainty that Congress can provide in terms of an ultimate answer on some of these questions.
Mr. George?
I think, and I agree with Mike that it's certainly very appropriate in my view, and I think a member's view, that Director DeMarco continuing managing, two of the largest companies in the world here in the United States, that they grow and evolve in their conservatorship state unless or until Congress tells them to do something different. As I indicated in my opening remarks, it is a very deliberative process to figure out what to do with the U.S. mortgage finance system. That is, multiple folks, including Congresswoman Maloney, have indicated the mortgage sector accounts for anywhere from housing sector accounts from 10 to 25% of the U.S. economy. It's going to take a while to figure out and to do that long-term plan. Having said that, we'd encourage Congress to act and move forward. I'm not sure there's a lot of folks that are optimistic in the secondary market that Congress will act in the very near term. So in the absence of congressional action, the director, acting director, whoever is in charge of FHFA right now has to exercise some leadership and move forward with Fannie and Freddie to deal with them as they are, and unless or until Congress gives them another direct order to do something different. So I think, as an example, creating this common securitization platform, really kind of blending in Fannie and Freddie as much as they can and making them start to look alike, I think is a very positive step towards any kind of long-term solution, but also in the near term, bringing those two together, making them more alike, making their securities potentially more fungible, and that is sort of the hope and the goal. Getting to that next step is something that he can do, I think, on his own as a matter of power and authority, and something he should do on his own and as part of the FHFA to move forward with Fannie and Freddie, again, until Congress can act and give him or his successor a long-term plan. What is it that they're going to do, and where will they go? Maybe coming back to the eminent domain points, I know there's a lot of issues around that. One of the key challenges of mortgages is upfront, everybody wants to get a mortgage, everybody wants to have a good rate. On the back end, when you have what we'll call credit risk, and credit risk could be defined as the 4 Ds, death, disability, divorce, and stretching it, disemployment, is that with those 4 Ds comes also the inherent economy risk too, is that when the U.S. housing market effectively tanked over the last 6 years, that brought not only a lot of short-term pain for folks who have trouble with their ability to meet their mortgage payments on a day-to-day basis, but the longer-term pain of equity depreciation in homes. Fortunately, we've had a significant turn in some markets. As an example, in Las Vegas, that took a very large brunt of the burden. They had a huge increase in home prices in the sort of the 2000, 2006 range. Since then, they had a big depreciation, but the recent Case-Shiller data indicates that year over year, home prices in that area have gone up 20%. Phoenix, Arizona. Similarly, lots of pockets in California that have seen a strong rebound because institutional investor money is coming back in, buying up homes, some turning them into rentals, others rehabilitating them, selling them, getting homeowners back into them. The key part of that, though, is the private market is functioning there. You don't have the external government influence coming in, using its coercive power, saying, we're going to take this and we're going to tell you what the value is. So going to your direct question of, would the government have to pay appropriate or just compensation? Yes, absolutely. We think, and I think institutional investors uniformly believe, that they would be ripped off in that solution, to be very frank about it. Because the current proposals from the Private Pooled Investment Fund, MRP, that is the sort of the company driving many of these debates, is they would say, let's take a current loan and let's pay anywhere from 65 to 70% of the outstanding principal value of that mortgage. So I, as an investor, I lent you $100. MRP is proposing they only get paid $65 or $70 back. Frankly, if I lend you money and you rip me off, yeah, sure, please. It absolutely would be made in a court. So the key question is, what data and how would the court evaluate that? There are folks in the secondary market, highly sophisticated, solely in mortgages, that have difficulties valuing outstanding mortgages, but they put much higher values than what are proposed out there than any of the related proposals. And I think the course of the last year has proved the institutional investors' view has been right, that they would have been ripped off had the MRP proposals been put through because of the significant home price appreciation that's occurred in these. So if, for example, in Las Vegas, if you were 20% down on your mortgage, the eminent domain proposal went through, and now they've got you back to 0% a year ago. Now all of a sudden, within the last 12 months, you will have made 20% given the home price appreciation in that market. So investors feel like they've gotten ripped off. Now the homeowners got a 20% windfall. That is a recipe for investors not coming back with their institutional capital to any market. In that case, if you build, Yankee Stadium in the middle of Iowa, no one will come, if those are kind of be the rules of the game.
without local governments having any say-so over that, because they're basically allowing them to go through tax foreclosure. Now they become a public charge, and the private side has been able to offload the liability. So there's two sides to that coin.
Oh yeah, absolutely.
We have a bell. We have 15 minutes. There are a lot more questions I think that people have, but before we take off for the floor, this has been a very, very good session that we've started with. But we have Mr. Ralph Nader in the room, and it would not be a meeting without having a little controversy. So I want to know whether or not Mr. Nader has a question that he'd like to put forward.
Thank you, Congressman Waters. Thanks for doing this. Obviously, the majority would not do this. Didn't have unofficial hearings today, briefing, so to speak. I'm concerned, obviously, with affordable housing and redlining over the years, but I'm also concerned with the double standard that the government has dealt with in terms of the shareholders, the common and preferred. Shareholders of Fannie and Freddie, who were told over the years, and many of these are people who put their shares away for a college education for their children and other needs. They were told over the years this was the second safest investment after treasuries. And in 2008, they were told more than that. They were deceived by both Chairman Bernanke, Treasury Secretary Paulson, and regulator
Jim Lockhart.
Yeah, Lockhart. And the record is clear here, and I put this in a letter to Secretary of Treasury at the present time. They were actually told this is a very safe investment, and Fannie and Freddie are adequately capitalized. Within a few weeks, in September, Fannie and Freddie collapsed and were taken over by conservatorship. If a corporate executive did that, even the SEC would wake up and say that there's deception here. The important thing is that the government allowed Citigroup shareholders to survive. I'm not talking for a subsidy here. They allowed AIG shareholders to survive when they bailed them out in huge amounts in a whole variety of ways in 2008, 2009. But they are indicating they may expropriate Fannie and Freddie shareholders. And the bad thing about this is that the government is using the common shareholders of Freddie and Fannie up to 20% in order so that the government not take on the liabilities of Freddie and Fannie. So they're using the shareholders on the one hand and abusing them on the other, and keeping them in a limbo. And nothing I've heard today, and nothing I've heard over the last year or two by officials in the executive branch indicate any concern that they save Citigroup and AIG shareholders to participate in the recovery, which they are, but they totally ignore and indicate they're going to vanquish and expropriate the common shareholders, and who knows what will happen to the preferred shareholders. So this is what I'd like to ask you. You're talking about eminent domain mortgages. How about expropriating these people? Now, there are day traders and all that, but there's still people and institutional shareholders who are hanging on and performing an important function inadvertently with the 20%.
Mr. Dodge, what about that?
So the first time I was asked to testify actually was a field hearing that Miss Waters, I dare not then nor now call her Max, was a field hearing that she had in November of 2007 in her district in California. And it was the first time I had ever testified before Congress. I can tell you that was probably the scariest event of my life, walking into a field hearing on mortgage servicing in your district. But you were very gracious, and Congressman Green also was out there as well, and asked not as hard a questions as I have. So thank you very much for not putting me on the spot as much as. But I think there's two sides of the ledger that you got to evaluate Mr. Nader's question by. There's what do we do now? So the Corker-Warner bill and future GSE reform, I think, is a big focus of lots of the policy debate now. How do we deal with Fannie and Freddie? How do we move them to the most efficient state to make the mortgage system in America work? Then there's the other side of the ledger for those who purchased the common and preferred shares. What do we do with them? So different ways to evaluate it. I'll weigh in with my own personal views. These are not reflective of anything other than Tom Deutsch's own views, is that there has to be a very significant focus on, we got to take Fannie and Freddie, put it into the right new system. And there's the Jim Milstein approach. I think there's the Corker-Warner that says, the government is going to take it, put it in the new FMIC, and use the facilities. I think most prognosticators that I've heard have said the commons and the preferreds are going to be in a very difficult position under that approach, under the Corker-Warner approach or any other approach. How you rectify that with the people who were promised different things, I think is extremely challenging for the federal government to try to make that whole, because when you evaluate, Fannie and Freddie have lost, I think they've drawn $186 billion from Treasury, and they've only paid back 130 some. That $50 billion, it's hard to say, we're just going to wave that away and make it go away, and pay those common and preferred shareholders. Yet, as you indicate, there are a number of people who feel like they were, ripped off or told other things that were actually true. I think that will end up being a matter not for Congress to deal with, but potentially for the judiciary branch to deal with.
Let me just say that thank you very much. The members really have to get to the floor. We have a whole series of votes that are on. But what I'd like to do is this. We have such an important panel with so much information and so many interested people here. Our staffs are here, all weighing in on the GSEs and where we're going, what we're going to do. I would like to ask the panel if we could give the audience an opportunity to ask at least 3 questions as we exit, so that they can get the benefit of your being here today. That would be very helpful to us. We're all dependent on our staffs to get through Corker-Warner and to help us as much as they possibly can in guiding us to where we're going to go or try to go on the House side. So if that's okay with you, we will exit. We will leave Miss Amanda in charge, and she will take a few questions. Miss Amanda. We'll take a few questions from the staff. Miss Amanda, would you please come? And I want to thank you very much.
Does anyone in the audience have a question? Anybody want to speak up? You can really project, and then I'll repeat your question for the people streaming online.
Get a bad price from the new secondary market. Is it harder to deal with? Leonard, just your remarks.
I think what Eric was asking is why CUNA or ICBA could weigh in why small lenders would get a bad price from a new GSE facility.
Well, it depends upon how the new GSE facility is structured. Historically, one of the causes for community banks to have problems with pricing is because pricing has been volume based, and community banks typically have very few loans as compared to other market participants, particularly if they're located in rural areas or small communities. So they can't deliver the volume, and certainly they don't have, as we look at proposals for new secondary market structures, we need to be able to sell loans individually because we don't have enough volume to create a securitization. And so the volume would have to be pooled or sold on a loan-by-loan basis. And if you're pooling it, then there's an intermediary that charges something for their service that gets tacked on. So it's a volume issue.
Our concern is less of what would happen under a new GSE. Our concern is a fully privatized or mostly privatized system. That's where the problem would exist, because the entities, the organization, or the business who is involved in the securitization would probably also be involved in origination. It's the case today. And there would be a conflict of interest there, that the securitizers would give a better deal to originators that were affiliated, the other branch of their big corporation that was originating the loans, and non-affiliated originators, smaller institutions like smaller banks and credit unions, would therefore be competing against the very large originators who would be likely be part of the same corporate structure as the securitizers.
And one more point to carry on with that. As I said earlier, if you're selling to your competitor or someone who can originate, then they have the information on your customer to cross-sell, and very often the community bank would lose their customer relationship there. They couldn't compete with that.
Kind of said a few things. If you look at the Fannie Freddie model, while this has gotten better recently, typically smaller lenders would pay guarantee fees 2-3 times as high as what a larger lender would pay. That differential has narrowed to the point where I think smaller lenders are more competitive today than they used to be. But that's a concern that we've had in thinking about what the future secondary market should look like. So our proposal, I think Corker Warner does a good job of this, tries to address it in 3 different ways. One is this creation of this mutual securitization company, which acts sort of like the Fannie and Freddie cash windows, allowing single loan delivery. A second is no volume-based pricing. In Fannie and Freddie, it was both volume-based pricing and even credit variances beyond their typical credit box, which led some lenders to get significant advantages in the marketplace. The third way to help smaller lenders is do something analogous to what Ginnie Mae does. They had the Ginnie Mae 2 program is a multi-lender issuance. A small lender can put as few as 1 loan into that multi-lender issuance, and they have the same standing as anybody else in that pool. So they're just as competitive as any other lender. So I think each of those 3 approaches, some ability to do a cash window-like execution, no volume-based pricing, and then multi-lender issuance is the way to address, make sure smaller lenders are competitive.
I want to just make one comment, and this is not necessarily about the individual pricing that you all are talking about, but one of the things that's of particular note is that we worry about access to capital and flow of capital to the B and C markets, and that is part of what the GSEs have provided is ensured is that pricing for there's a lot of people that want to be in the A markets, in the primary markets, but we do worry about the access to capital in the B and C markets and the pricing that would be impacted, in a totally private market, and whether or not there would be financing. So.
And I think realtors would second that concern, mainly because we have people in every market in the country, and what we don't want to see is that there is some sort of prevalence given to what we would call the tails, where money would flow there and not into those B and C markets, either driving up capital cost in those B and C markets or absolutely just shriveling it up and making it go away. So any proposal, and we do believe Corker Warner has actually addressed a number of our tenants, but we view that more as a framework than anything else. Right now, 152 to 159 pages of GSE reform just seems a bit light, but we think that that it does seem more like a framework that we can work with. I mean, and that these issues are addressed, but the key is, how will you flesh it out? How will you put more meat on the bone and actually put things in it that will actually work and not act to constrain the marketplace, along with allowing the level of flexibility I think that Bill mentioned to ensure that during a transitional period we don't overly constrain ourselves and send us down a rabbit hole.
Do we have other questions from the audience? I'll ask a question if nobody else. Question? Anybody?
Housing Trust Fund, which is authorized in the Housing and Economic Recovery Act. It's our understanding that the amount of funding that would go to the trust fund under the structure provided in the bill would be less than the HERA baseline. I would just say that we have the National Low Income Housing Coalition would definitely advocate for the HERA baseline being the minimum amount of funding provided to the trust funds in a House bill. I don't know if anyone wants to comment on that, or if anyone has reviewed the market access fund portion of the bill.
We haven't reviewed it in that detail, but we understand it would have to be a decision that Congress would make to fund it, and both. We understand that the users of the secondary market are going to have to pay some. We don't want to pay too much, and so we would just trust Congress to come up with a reasonable number that represents the value.
Ted?
The volume driving the price differential versus competing against a firm that is also an originator. I want to focus on the competing against a firm that's also an originator, because isn't the logic of requiring skin in the game that there should be a difference in price for firms that are originating, that have affiliations with their originators, for ones that are pure arm's length? Isn't the logic that there's less conflict of interest, less chance of a lemons market if a securitizer has some attachment to the originator? So I guess I'm sort of asking you to justify why we should prohibit differential in pricing if there's a belief that it could affect whether or not there's a lemons market.
Yeah. Well, let me tell you how I think about the market. In 2011, there were 7,500 lenders that originated one or more mortgage. Right? About 1,000 of them go directly to Fannie and Freddie, and about 250 are Ginnie Mae issuers. Right? So there are about 6,000 lenders that, for their business model, it makes sense for them to sell to an aggregator or to sell on a whole loan basis. But for those 1,000 that go directly to the secondary market, we need to build something that works, right? Because they're making the decision that they're going to be active in the mortgage market. They want to go directly to the secondary market to have a competitive price. We need to have something that works for them. So that's what we talked about, sort of those three branches of execution that can allow them to do that. There always are going to be some minimum standards in terms of net worth, in terms of management capability, but again, for the people who want to be mortgage lenders and have the capability and sophistication to do that, you need to have a secondary market that allows really vibrant competition among those 1,000 or so.
I think the skin in the game requirements will apply equally, though, for whether you are, quote unquote, an aggregator, you're buying from lots of smaller originators, and then you're the securitizer. You still, under that circumstance, you still have to, and this is, let's say, the Redwood Trust, who's issued a number of private label securities recently. That's the Redwood model, is they buy from third-party originators. They do their diligence. They issue off, let's say, the AAA securities, and then they retain a lot of the sort of the equity or first loss positions because they believe they've done good due diligence and that they'll get good returns off of those, subordinate bonds because they've done that sort of third-party origination, and that is, quote-unquote, their skin in the game. So, but even if someone didn't do it in the Redwood model where they're just aggregating loans and then selling off everything that they can, they still are going to be required under the risk retention rules to retain a 5% vertical or horizontal slice. So I don't think risk retention will change it. I do agree with Ann, though. I mean, when you look at it from an institutional investor point of view and you're buying securities now, and let's say under the Corker-Warner bill, you have exposure to credit risk under those circumstances, they do have to do diligence on the underwriter. You can't just say, well, every loan, just because the data is the same, let's say it has the same FICO score, it has the same down payment, et cetera, they're still going to do diligence on each individual underwriter originator within that pool to make sure that that meets their standards of what they view as good and credit-worthy origination. And that does create, I do believe and agree with Ann, that does create some challenges for smaller originators, because when they're not doing as much volume, the diligence costs from the investor, which you want the investor to do. You don't want them blindly buying securities like maybe some of them were doing in 2006. You want them evaluating each one of those originators, but doing so does create that heightened cost, which does give some competitive advantage to, you know, the bigger movers.
Related to that, this is somewhat ironical that the credit unions being smaller might be more expensive on a per institution basis to do the due diligence. However, our loss rates are lower than just about anyone else's, and I think small banks have a similar experience. So, you know, what in the previous system we were penalized for lower volumes, we weren't rewarded for the much greater credit quality of the underlying securities. And if something can address that, we'd be really happy.
I think a good sales pitch book to investors showing the data will be exactly what they'd like to see.
We have it.
Tom, I was just wondering, back to my thought about the B and C markets, I'm wondering if you could comment just on the investment community's view of primary markets versus tertiary markets and how they see this going forward. I'm just curious.
Well, I mean, right now, as I indicated, the private label securities market is extremely small. And what is being originated, it's not even prime, it is ridiculously prime. I mean, they are loans that I think every one of us in this room wish we could get. It's 35% down payments, average FICO scores of 780. Those are not loans, I think, on a future state of what we're looking for the private markets to be able to handle. We're looking for them to be able to handle 700 FICO scores or 650 FICO scores, down payments, let's say at 20%. That's the kind of the market where you want to see the private capital come back generally, I think, from broadly. Beyond that, then, institutional investors will run the models. What is the performance for different markets? Is the performance in the housing market in market A, is that as good as market B? There's always concern among investors when they look at California, Nevada, Arizona, Florida, because they have wilder fluctuations. Where I grew up in Kansas, I don't know if home prices have appreciated at all in the last 20 years. I don't think they've depreciated at all in the last 20 years. I think my folks' home is probably pretty much the same value it was 10 years ago or slightly more. But those fluctuating markets, those create more risk and more reward as well. And I think institutional investors who've put a lot of money in the last year have been rewarded handsomely for going into those markets. If you invested in Phoenix 2 years ago, you've gotten a 30% return. And in those 2 years, that's a heck of a lot better than certainly the last few weeks in the equity markets. So, I mean, as I indicated at the front or at the outset, any investor will buy any product just at the right price and the right terms. But they're always going to do that due diligence to evaluate, is this going to provide a better or worse return? And that's exactly what you want big pension funds and mutual funds to do in putting that private capital to work.
If anyone else has a pressing question, we might be able to entertain one more. Otherwise, I think I will wrap the panel. Anyone? Okay, then. Well, on behalf of Congresswoman Waters, thanks to everyone for coming. Thanks to the panelists.